Now, we ended the last segment on this chart, and we want to start the segment on this one because I think it's important to appreciate where we sit in terms of that catch-up trade. And the catch-up trade has always been China's been exporting a significant amount because they've seen the supply recovery. They haven't seen the demand side, which we'll talk about more. But at what point does the supply catch up? And we've already seen prices increase exponentially for container ships coming from China. And we've started to see this bifurcate or this diversification of supply chains away from China a bit. So you're starting to see that broaden out to leverage Southeast Asia, South Korea, Japan at a bigger percentage. So this is where we start looking at what were the trajectories and where do we sit right now. And you can see on the normal trend level, some of this pressure is going to be to the downside, especially when you think about prices going up. All of these issues are rising. This is why we think that, with exports to the U.S., are more exposed, and this is the export forecast returns to 2012 to 2017 trends. So we're just looking at trend levels. Then when we look at estimates for EU, so exports to the EU are similar at this high, and again putting more weight on what the problem could be at the Chinese level. And now we're going to go through why we see that overall and what is causing that, especially as some of these subsidies go away for some of their exports. And before we get into it, I thought this was just a funny chart. So it's just the global energy mix of renewables. Now I've seen a lot of charts in my life. There's always a plateau. There's always some hiccups. There's cost involved. So the fact that there's an assumption that renewables are going to go from 8% in 2020 to 60% by 2050 in such a perfect straight line, while everything else just goes away, is something. I don't really know what you would call it, but let's just say that this chart is going to be difficult to achieve especially when you look at raw material costs and just who is adopting it, where is it being adopted, Are we going to see China and India jump to renewables, or are they going to jump to gas first? And again, we talk about, especially from our private equity fund, we talk about the importance of a basket approach, and what can work in one area may not work in another. So if you're in an area that gets ton of sun, very little clay, solar may be great, especially if you have the land. If you don't, then does natural gas make sense? Or does solar with a natural gas backup? There are things that it's not going to be perfect. And that chart is just showing a perfect move, and which is why we continue to talk about pricing. And at some point, you have a lot of subsidies. Can those subsidies last? Are you going to see some pullback in general? So that's it. There's going to be a lot of pressure points that we need to look at overall and just in general. So then when we look at worldwide lithium, speaking to the renewable adoption, this is just showing you total demand. So when you look at total demand, if total demand is going up, you don't have enough supply, well, by 2035, the costs are going to be astronomical because you're going to have to pay people or incentivize people to go find more, which is going to increase your price, which is going to slow down adoption. So again, these are some of those mismatches that we continue to see based on expectations for renewables, which is something that I think needs to just be managed in general. And the reason why we talk about this is because China is a huge benefactor of the green push. So if you take Chinese growth and pare back some of this green movement, what do these growth numbers start to look like? So just going into some of the data points, we talked about China PMI composite and services, being on the Caxton side getting better, but how much better are they getting? And when you look at their official data, it's gotten a bit worse, and this is showing something that's quite opposite, which is why we think that there is this disconnect between what the boats are showing. So what we've been seeing is that imports have slowed, where exports have gotten a bit better. So when you look at the year over year, so given year over year is a bit easier, but imports were expected 33.6, came in at 32.2%. Exports were expected at 12.5%, came in at 22.2%. we're seeing imports slow. So remember what we keep talking about with imports need to be brought in, especially China that's importing semi-finished goods, raw materials, exporting finished goods, and even semi-finished goods, that they need those imports to feed that beast. So if you continue to see imports trend lower, which is what we're seeing, that means that exports will start to roll over. And if you consider where the exports are in relation to historics to Europe and the U.S., it makes sense to continue to see a little bit of those headwinds come through. Now, take that to the next level and look at CPI. So CPI was expected to be at 1%, came in at 0.9%, but PPI. So PPI was expected to be at 6.5%, came in at 6.8%. The cost of doing business, the cost of these goods continues to go up. So how can they continue to subsidize these price increases as raw materials, especially in China? You have iron ore, steel, rebar, copper. All of these things are reaching all-time highs, multi-decade highs that are just weighing on what is the overall cost going to be for these assets, which again is going to start to push individuals, countries, companies into other areas. So now let's look at new loans, because we've been talking about the slowdown in financing, and this is showing it come to fruition. So when you look at aggregate financing, it was expected to be at 2.3 trillion, came in at 1.85 trillion. New yuan loans were expected to be at 1.6, came in at 1.47. This is where we continue to see this reduction in money supply. So you can look at M1 was expected at 7.1%, which was from the prior, came in at 6.2%. M2 was expected at 9.2%, came in at 8.1%. So you have M0 that's up, but M1, M2 is continuing to slow down because they keep trying to pull liquidity out of the market. So if you don't have that monetary policy, that liquidity getting pumped in, well, then your credit impulses are going to continue to pull down. And that's this is April data, and that's what we continue to see in May, which is why even, yes, we're not to say that we're going to see these commodity prices just collapse, but they're going to slow down their increases because PPI is going to naturally slow things down because those prices will get passed through to the consumer, but you also have less liquidity being pushed into the market. So looking at it a little bit differently. So when we look at diminished Chinese stimulus, here's you can see the big turnover in terms of stimulus, but the CRB raw industrial index continues to remain elevated and actually driven higher since this point. So at what point are we going to start to see this? Now, because there's supply chain issues, there's shortages in the market, I am not saying that this is going to fix itself instantly, but to see it continue to go up, especially when you see just how slow these impulses have gotten and how that continues, because this is looking at advance by 9 months, and we're already seeing that accelerate. So how is China or the CCP addressing this? So let's look at, so the officials had a meeting at the Politburo, where the meeting pointed out that the current economic recovery is still unbalanced while the foundation is not solid. So they're concerned because it's very unbalanced. You have the supply drive, but you're not getting that solid foundation that they want in terms of just actual consumption. So with production up to speed, lagging consumption is still the biggest headwind facing China, which is why production has gotten there, but we're just not seeing those levels of activity, even though we had a big consumption period, because as soon as the Labor Day holiday was over, it immediately reversed lower in terms of activity and spending. So what are they going to do to try to pump up consumption? The CPC people must support the continuous expansion of domestic demand with the general growth of urban and rural residents' income. That, again, they have no way to increase. So they're struggling. So they're essentially saying, give people more money, they'll spend more. But we've seen that it's struggling to see this expansion. So Xi told their comrades to control the wealth gap. We must not allow the gap between the rich and the poor to widen. There must not be an insurmountable gap between the rich and the poor. So looking at income, again, back to transferring wealth to try to drive local consumption, but it's going to be difficult when you look at, you're pulling some of this additional just stimulus out of the market to try to essentially cap what we've seen so far. So top-ranking Chinese officials have long studied the collapse of the Soviet Union by intimidating that China is in danger of repeating one of the USSR's critical mistakes. Xi is underscoring the issues because they are saying that they didn't close the gap with the USSR. And I mean, you can talk to many people from the USSR or lived behind the Steel Curtain. They may disagree because it's just a lot of people were poor, and there weren't a lot of rich people on the top. You did have your normal top level that always exists in the communist regime, but the pain kept growing, and then you had the collapse. But again, we could do a whole dissertation, and I could do segments on Russia and USSR. But the big picture is the party also sees reducing income inequality as a means of vaulting China over the middle income trap. But how are you going to do that when you're pulling stimulus out of the market because your economy has run so hot and has been financed by such high levels of debt that this is going to impede growth in the near and medium term? So then when we look at just the slowing pace, as you pull down this debt, as you pull this liquidity out of the market, the infrastructure investment is going to continue to slow. So yes, year over year, it looks great because you have easy comps, but even as the comps get harder, you're still pulling this down and you're going to draining this capital, which again is speaking to the slowdown in economic growth, which is going to slow consumption, as well as their ability to compete or their willingness to compete in unfavorable terms in the export market. So then when we look at social financing, this just puts into context just how far it's fallen in terms of just percentages. So the aggregate social financing is back down, and you're seeing some net drawdowns from foreign currency bank loans as well as trust loans. Now, yuan bank loans are still there, though much smaller. And when you look at just the corporate bonds, you can see that corporate bonds are essentially steady, but the biggest component is going to be those yuan bank loans because they continue to try to take those bank loans out of the system to drain some of this excess liquidity, which is why when we look at this composite PMI, it's difficult to see how it's going to accelerate higher. Not to say that, especially Caxton, just based on the way they're coming up with the math on it, it's that you're going to start to see it roll and then flatline. So you'll still see some expansion because production is still elevated. But remember, this is a compounding component, and we're not seeing the consumption response. So it has to go into the export market. The export market has headwinds. So that's when we look at imports, and imports are starting to roll as exports we think are going to come under additional pressure. Again, speaking to some of those slowdowns that we are seeing in the system. So when you think about the activity and the consumption, you have to look at the population. So according to China, the overall population grew, but at a very reduced rate. So total population reached just over 1.411 billion in 2020. According to the census, far fewer babies were born in 2020. Chinese mothers gave birth to just 12 million babies, down from 14.65 in 2019. The observed fertility rate is just 1.3%, which is well below the replacement rate of 2.1. So the population is also aging faster. People over 60 years old now account for 18.7% of the population versus 13% in 2010. People between 14 to 59 are 63% of the population, a near 7% drop. So this is where we continue to see this consumption pattern. How, when we look at growth rate and capacity, how are they going to continue to drive this growth? So, which is why we're going to see this slowdown. You're going to see this natural progression lower. And the other issue is it's not just China, because in segment one, we talked about not only just Chinese growth, but also global population growth, and it's slowing. And as it continues to slow, that's less consumers, that's less replacement, that's just higher costs to do business that is going to continue to weigh on some of this just general macroeconomic growth. Now, this can be mixed in with the fact that the State Department came out and said that, and just to give you the exact quote, because I actually retweeted it. If you're not following me on Twitter, I tend to be very active in general. But when we look at just what has happened, so China increased use of forced sterilization in Xinjiang, and China detained more than 1 million in Xinjiang since 2017, according to the State Department. So the U.S. is saying that we know you're doing more, and this is what is happening in general. And this is where we continue to see pressure points, not in terms of this friction with the U.S. The U.S. is saying this, so we're going to turn around and buy more stuff from you? No, we're going to continue to diversify, and this is some of those additional pressures on China. Now, just an update, the Hamas Minister of Finance has just been destroyed, so we're seeing more pressure, again, as we talked about in the first segment, on Israel and the Gaza and these pressure points, which is why we think that there's not only going to be more rocket barrages, but there's also going to be a ground offensive. So now shifting into the talk on sanctions, because again, you have to think about PMI sanctions and what does this mean? Huawei smartphone sales have collapsed. Now, there is a chip shortage, but remember, Huawei bought a ton of chips ahead of sanctions to make sure that they wouldn't have the type of supply disruption. So you're seeing it drop around the world, but more importantly in China. It speaks to the pain pressure or the pressure threshold of local consumption and the Chinese consumer, which continues to deteriorate because, this is just one component, like smartphone sales, but you're seeing this pressure overall. And it's not just like Western Europe is down, and then these sanctions are going to eat further, as you can see from Q3 of 19 on down. Latin America, you're starting to see a bite from sanctions, which is going to limit exports, which is going to limit just general activity and economic growth within China. So then when you look at emerging market inflation, China is trending up, but look at all of these shifts to the right. These increases in inflation are just going to put more pressure on local consumption. And these are not rich individuals. So as inflation goes up, their ability to spend, to stimulate, to consume is going to go down, which again speaks to how robust is the underlying macro recovery going to look like as we see these pressure points come into the system overall. So now let's take it to the next level. So now let's look at India. So now we look at India industrial production by segment. So it was a little bit better than expected in terms of what happened, but it was for March. So we know that we had additional shortfalls come in April, which is going to make things is again going to stress some of that capacity, because March we're still getting a little bit better, especially in India, which has slowed down considerably, which again speaks to why we think there's going to be an underlying pressure for Indian growth on the other side of COVID, because as we showed earlier in segment 2 and 3, even though stringency indexes haven't gotten as bad in India as previous, we've seen consumers do much less. And again, this is the pressure on inflation, and this is the pressure just in general. So when we think about where the underlying growth really came from, this is why we think that some of these estimates are going to come back down, and we're going to see these pressure points just in terms of where things are going to go overall and what that's going to look like in general. So when we switch over to India, so now we're going to switch over into India. So industrial production year over year, it was expected at 20%, came in at 22.4%. So again, this is some of the things where it beat to the upside, but the pressure really comes in April. So when we look at April, that's where we're going to start to see some of those COVID impacts. So now when we look at inflation, so inflation in April, speaking to the pressure points, it came in at 4.3%. March was 5.5%, but even though it's only at 4.3%, we're not seeing prices come down, even though we're seeing a huge amount of restrictions and the consumer do less. So the stickiness in this inflation, as we start to come out of those COVID shutdowns, that's where we're going to see some of this acceleration. Because if you look at meat and fish, fats and oils, cereals and products, food in general remains elevated with more to come behind it. And food and beverage was down, was at 2.7%. because of vegetables. But again, it's going to come back to, as people just have done less, as they start to do more, we're going to see that inflation accelerate, which is why when we look at the data underlying it, new cases continue to go up, active cases go up, while vaccine doses continue to, now while they've gotten better, they're still far below where they need to be to see some of this repair in general. So then when we shift over to the industrial output based measures, you can look at what drove this. So primary, for March was at 7.7, intermediate was at 21.2, capital was at 41.9, infrastructure at 31.2, durables 54.9, non-durables at 27.5. So some of the biggest growth sides had some increases up, but when we look at the use base in general, industrial production has slowed. If you look at diesel, if you look at gasoline, and these are headwinds that are not going to go away. They're actually going to start to get worse as we come into April and May. So now when we turn over into Japan, you can see that there's been some benefits. Japan has gotten a little bit better, except when we look at services. So services, given they were better than last month, but they're still not back to this growth level. But household spending has been up. And when we look at PMI composite at 51, back into a growth level, and you look at bank services PMI, again, not quite growth, but also not declining all that much either. So we're getting some movement out of Japan. The question is going to be, are the restrictions or are the COVID cases going to impede some of the full-on recovery? And that's something that we continue to see, where things are getting better, but again, not back to where we would like them to be, just based on some of the movements, but all of them moving in the right direction. But if you remember, cases got a bit worse, lockdowns increased in April and May. So some of this will take a breather and then start to get a bit better into the summer. Then when we look at Taiwan, so Taiwan CPI in general continuing to drive higher, but Exports went up again in April, expectation for 27.6. Exports were actually at 38.7. Imports are, again, some of the issues. Imports were expected at 27.2, came in at 26.4. So we're starting to see a little bit of a contraction on the import side, which speaks to some of the slowdowns that we're going to start to see on the export side. And this is those friction points as you have inflation going up, as you have PPI going up, and you're starting to get some of these slowdowns in some of these side areas, which is why, again, we talk about Asia so much. Then when we look at global chip exports at top 80%. So when we look at Asian share of global semiconductor exports, this is where we need to see more exports of chips because of the lead time, but we're starting to see some of that slowdown. Now, is it because some of that chip capacity is caught up, or is it because we're seeing a little bit less demand? And these are some of the capacity, because we still see a huge amount of exports. But again, I don't think the chip shortage is going to end by year end. Others disagree. It's going to be an interesting dynamic to see if we can get some of this normalcy as we have new COVID cases and some slowdowns in some of these regions. That is putting some headwinds on production, and just raw material costs continue to go up, which is, again, limiting the amount that they're able to purchase and bring in-house. So then when we look at sales of semiconductors, these are the ones that have fueled a lot of Taiwanese exports. This is where we start to see some of the rollover. Not to say it's going to go far down, but we're starting to see that pressure, especially because as prices go up, people are just going to try to wait and do less because those costs are extensive. So then when we looking at India recovery, so the IMF continues to see India clocking that growth level. But as we keep talking about the inflation, the pressure internally, the slowdown in consumption, that's where we continue to see these headwinds that I don't think are fully appreciated just in the underlying market. So then when we turn over and look at that China credit impulses and U.S. emerging market index, here you can see just where that index looks, and one of the reasons why I think pressure is going to remain in emerging markets, especially when you look at the U.S. yield curve going higher, pressure coming in, and China trying to pull against some of these indexes in general. China's just slowing down. So when you look at where China's going, where that monetary policy is going, where that stimulus is going, it's going to continue to pull down a lot of these EM currency indexes in general, which I think is going to be a bigger weight in terms of some of those pressure points that we're going to continue to see in general. And now thinking about that overall, well, what is being done? So China is cutting the monetary policy or tightening monetary policy, but the National Development and Reform Commissions, or the NDRC, laid out a specific cost-cutting program aimed at extending COVID-19 relief for enterprises, in continuing to reduce tax burden, reducing institutional transaction costs, reducing labor, land, and energy costs, shoring up enforcement of timely payments of small and medium enterprises. So reducing land, labor, and energy costs are very difficult when all those prices are going higher, again, leading to some of these friction points that are going to remain in the system. They're also looking at tax reductions. The most explicit prescription, the VAT threshold for small-scale taxpayers, will be raised to 150 renminbi of monthly revenue, up from 100. Income taxes will be halved for those with less than 1 million renminbi in annual taxable income. 75 tax deductions for R&D expenditures. Again, all of these just lead to less taxes, but what are less taxes? Less revenue. If the government has less revenue, it's going to be harder to stimulate, which is why we continue to see some of this contraction in activity, which is when we start looking at China's credit cycle and what does it mean for emerging market credit. Here you can see the social financing impulses, as we've been talking about. And this is why the credit markets we still think are going to get much worse in the emerging market realm, especially as U.S. yields go up. Pressure is going to mount as we continue to see these pressure points, again, pulling down this number, which is why we think emerging market stimulus, emerging market activity, consumer growth is going to be a struggle. So then when we turn and say, okay, core inflation the Chinese core inflation is going to be pulled up just based on what we're seeing in the U.S., because China's core inflation is notably below that in the U.S., which is why we think there's going to be more pass-through. But again, the local government in China is trying to do more to stimulate and to adjust and to try to insulate. But when we look at China PPI is going in one massive direction, which is up and out. Now, when we talk about the smelting and the other side on the PPI, we think it's going to flatline, not that it's going to continue to drive higher. And when we look at 16 and 17, that's where we had a significant amount of stimulus come into the market. Now, China put a new significant amount of stimulus into the market, and they're taking it back. So you can see what happened when they started to take it back in 2018. This is something that we think is very likely to happen in 2021. Not to say that it's going to collapse, but there's going to be that pressure and that sideways move in general. And this is just looking at India as we talk about the expectations for inflation. And I think Bloomberg Economics did a great job in showing that move down, but they see it coming back up to that 6% level, because they have a very similar view to what I'm thinking of, where the trend is going to be back up, especially when you look at just kind of what that driving force is going to be for a lot of those numbers and a lot of that pressure from the consumption level, from just cost, and then obviously PPE. All of these other issues remain when we look at India and some of those growth trajectories. So I know it was a lot. That's all we have for you today. If you have any questions, please let us know. We love the back and forth. I'll try to put another thread on Twitter just to try to keep things interesting and engaging. And we always love the back and forth on the YouTube channel comments. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.